Hello mga Yuski, welcome back again to my channel. Ayan. So, another video na punta guys, mga Kayuski. So, napunta elements of accounting and accounting equation. So, ABM 101 gyapon ni siya. So, ang iyang course title is Fundamentals, Accounting Business and Management. So, muna among module 3 which is elements of accounting and accounting equation. So, intended learning outcomes, ang iyang outcomes ani is describe the relationship among asset, liability, and capital. Differentiate asset, liability, and equity. And explain the basic accounting equations. So elements of accounting and the accounting equation. So the three major elements of accounting are assets, liabilities, and capital. So these terms are used widely in accounting, so it is unnecessary that we take a close look at each element. But before we go into them, we need to understand what an account is first. What is an account? So the term account is used often in this. Thus, we need to understand what it is before we proceed. In accounting, an accountant is a descriptive storage unit used to collect and store information of similar nature. For example, cash. Cash is an account that stores all transactions that involve cash receipt and cash payments. All cash receipts are recorded as interest in cash, and all payments are recorded as deduction in the same account. Another example is building. So suppose a company acquires a building and pays in cash. That transaction would be recorded in the building account for the acquisition of the building and a reduction in the cash account for the payment made. So now let's take a look at accounting ends. So which is first is asset. So assets refer to resources owned and controlled by the entity as a result of past transactions and events, from which future economic benefits are expected to flow to the entity. In simple terms, assets are properties or rights owned by the business. They may be classified as current or non-current. Current assets are considered current if they are held for the purpose of being traded, expected to be realized or consumed within 12 months after the end of the period or its normal operating cycle, or whichever is longer. Or if it is cash, example of current assets accounts are. So, ano siya ang mga example of accounts assets. So, current assets are considered current if they are held for the purpose of being traded. So, expected to be realized or consumed within 12 months after the end of the period or its normal operating cycle, or whichever is longer. Or if it is cash, example of current assets accounts are cash and cash. First is cash and cash equivalents. Bills, coins, funds for current purposes, check cash in bank, or etc. Receivables, accounts receivable or receivable from customers. Notes or received by promissory notes, or for example rent receivable, receivable, interest receivable, due from employees or advances to employees, and other claims, allowance for doubtful accounts. This is a valuation account which shows the estimated uncollected amount of accounts receivable. It is a contra asset account and is presented as a deduction to related assets or accounts receivable. Inventories. So ikatulad siya ang inventories, assets held for sale in the ordinary course of businesses. Next is prepared expenses. Expenses paid in advance, such as prepaid rent, prepaid insurance, prepaid advertising, and office supplies. And next for the asset is non-current assets. Assets do not meet the criteria to be classified as current. Hence, they are long-term in nature, useful for a period to be longer than 12 months or the company's normal operating cycle. Examples of non-current assets accounts include: first is long-term investments for long-term purposes such as investment in stocks, bonds, and properties, and funds set up for long-term purposes. Next is land area owned for business operations or not for sale. Next is building, such as office building, factory, warehouse, or store. Next is equipment, machinery, furniture, and fixtures or shelves, tables, chairs, or etc. Office equipment, computer equipment, delivery equipment, and others. So accumulated depreciation. This is a valuation account which represents the decrease in value of a fixed asset due to continued use, wear and tear, passage of time, and obsolescence. It is a contra asset account and it's presented as a deduction to related fixed assets. Next is intangibles, long-term assets with no physical substance, such as goodwill, patent, copyright, trademark, and etc. Next is other long-term assets. Liabilities. So liabilities are economic obligations or payable of the businesses. Company assets come from two major sources: borrowing for lenders or creditors, and contributions by the owners. The first refers to liabilities, or the second to capital. Liabilities represent claims by other parties aside from the owner against the assets of a company. Like assets, liabilities may be classified as either current or non-current. A current liabilities is considered current if it is due within 12 months after the end of the balance sheet date. In other words, they are expected to be paid in the next year. If the company's or normal operating cycle is longer than 2 months, a liability is considered current if it is due with the operating cycle. Current liabilities include trade and other payables, so such as account payables, notes payables, interest payables, rent payables, accrued expenses, and etc. Current provisions, estimated short-term liabilities that are probable and can be measured reliably. Next is short-term borrowings, financing arrangement, credit arrangement, or loans that are short-term in nature. So, current portion of a long-term liability. So, the portion of a long-term borrowing that is currently due. Number 4 is current portion of a long-term liability. The portion of a long-term borrowing that is currently due, for example, is for long-term loans that are to be paid in annual installments. The portion to be paid next year is considered current liabilities, the rest non-current. Or next, current tax liabilities. So it's all about taxes for the period and currently payables. Non-current liabilities are considered non-current if they are not currently payables. They are not due within the next 12 months after the end of the accounting period of the company's normal operating cycle, whichever is shorter. In other words, non-current liabilities are those that do not meet the criteria to be considered current. Makes sense that non-current liabilities include long-term notes, bonds, and mortgage payable, deferred tax liabilities, and other long-term obligations. Capital, also known as net assets or equity. Capital refers to what is left to the owners after all liabilities are settled. Simply stated, capital is equal to total assets minus total liabilities. Capital is affected by the following. First is initial and additional contribution of owners or investments. Second is withdrawals made by owners or dividends for corporations. Third is income, and fourth is expenses. So owner contribution and income increase capital. Withdrawals and expenses decrease it. The terms used for the company capital portion vary according to the form of ownership. In a sole proprietorship businesses, the capital is called owner's equity or owner's capital. In partnerships, it is called partner's equity or partner's capital. And in corporation, stockholders' equity. In addition to the three elements mentioned above, there are two items that are also considered as key elements in accounting. They are income and expense. Nonetheless, these items are ultimately included as a part of a capital. Income. So income refers to an increase in economic benefit during the accounting period in the form of an increase in assets or a decrease in liability that result in increase in equity, other than contribution from owners. Income encompasses revenues and gains. Revenues refer to the amount earned from the company's ordinary course of business such as professional fees or service revenue for service companies and sales for merchandising and manufacturing concerns. Gains come from the other activities such as gain on sale of equipment or gain on sale of short-term investments and other gains. Income is stored every period and is ultimately included in the capital accounts. Examples of income accounts are service revenue, professional fees, rent income, commission income, interest income, royalty income, and sales. Expenses. Or expense. Expenses are decreases in economic benefit during the accounting period in the form of a decreased asset or an increase in liability that result in decrease in equity, other than distribution to owners. Expenses include ordinary expenses such as a cost of sales, advertising expense, rent expenses, salaries expenses, income tax, repairs expense, and etc. And losses such as loss from fire, typhoons, and loss from thief, like income expenses, are also measured every period and then closed as part of capital. New income refers to all income minus all expenses. The accounting equation is the unifying concept in accounting that shows the relationships between and among the accounting elements, assets, liabilities, and capital. So we have a basic accounting equation. The basic accounting equation is asset equals liabilities plus capital. When a business is put up, its resources or assets come from two sources: contribution by owners or capital, and those acquired from creditors or lenders or liabilities. In other words, all assets initially come from liabilities and owners' contributions. As a balance transaction takes place, the value of accounting elements change. The accounting equation and nonetheless always stays in balance. So assets are found at the left side of the equation, which we term as debit, while liabilities and owners' equity are found at the right-hand side of the equation, which we term as credit. The final rule is the total of the left will always equal to the total of the right. And this is the significance of the double entry system of bookkeeping. Every transaction has a twofold effect, meaning at least two accounts are affected. So let's illustrate all of the through these examples. Assume that following transactions. Mr. Alex instead 20,000 pesos to start printing business. The company obtained a loan from a bank, 30,000 pesos. The company purchased printers and paid a total of 1,000. How will the transaction affect the accounting equation? So on transaction is owner investment, asset is 20,000 pesos, liability is none, capital is 20,000 pesos. Again, every transaction has twofold effect. In the above transaction, assets increase as a result of the increase in cash. At the same time, capital increased due to the owner's To the owner's contribution. Remember that capital is increased by contribution of the owners and income and is decreased by withdrawals and expenses. No liability is affected,